Well, the S&P 500 notched its first back-to-back declines in a month last week as treasuries traded in mixed fashion and the dollar faced some modest headwinds with a barrage of tariff headlines continuing amid a solid US labour market report and a frankly shambolic decision from the Bank of England. This week, trade, of course, remains in focus as Trump targets metals, but the data docket is also busy with US CPI, retail sales and fourth quarter UK GDP on the slate as well. Plenty for us to discuss on the trade-off this week. Without further ado, let's crack on with the show. Well, third time lucky with the introduction there, but joining me as always to try and make sense of what's going on in financial markets is a man who makes no mistakes at all unless it's calculating the winner of his non-farm payroll sweepstake, and that is, of course, Ryan Littlestone from Forexflow Live and Forex Analytics. Ryan, a very good afternoon to you. I'm sure your weekend was much happier than mine as I was nursing my narrow defeat in your sweepstake.
Well, I can tell from your face you've had plenty of sour grapes over the weekend, but just for all the, I want to make it clear. I want to make it clear here and now. There are rules, and we have these rules for a reason, because without rules, we're all animals. It clearly says in the rules, if you pick a number and someone's taken it, then they're first to that number, but you can pick another one. So you were second to your number, therefore it doesn't count. You're disqualified. You may have come a couple off of it, but I'm sorry, rules is rules.
Oh, dearie me, dearie me. Right, well, let's get on to that jobs number because it was an interesting report nonetheless, despite the shenanigans going on with our sweepstake. So the payrolls number, 143,000 in the month of January, just a whisker away from my guess of 145,000. And even if Ryan won't give me the official win, I know in my heart that really I was the victor in that sweepstake, despite being robbed once again. More seriously, though, the jobs report did show that the labour market just continues to tick along very nicely. I think everything was pretty solid, to be honest with you. Not only did you have that 143,000 headline number, about 30,000 off consensus, which when it comes to payrolls is a mere rounding error. You also had a 100,000 upward revision to the December and the November prints, which in turn took the 3-month moving average of job gains to almost 240,000, which is its best level in a couple of years. The annual benchmark revision, that was minus 589,000, but the preliminary estimate for that was minus 818,000. So considerably better on that front as well. You then look at unemployment, fell to 4% as 2025 got underway, and that came even as labour force participation rose to 62.6%, getting back towards those cycle highs that we saw towards the middle of last year. Bit of a best of both worlds scenario there. Not only have you got more people in employment, you've also got more people in the labour market looking for employment, which is a very, very promising sign indeed. And then you look at average hourly earnings. Now, they were a little bit hot at 0.5% on a month-on-month basis, up from 0.3% that we saw in December. But this was largely a function of a shorter work week, and that was due to the wildfires that we saw in California and also the big snap of cold weather that hit the United States during the payroll survey week. So I don't think that's particularly concerning. And all in all, it's a report that was firstly very, very solid indeed, and secondly is one that will probably keep the Fed on the sidelines for the bulk of the first half of the year. We obviously heard from Fed Chair Powell at the January FOMC press conference, and of course he's up on Capitol Hill this week, but he said that the two conditions for a cut are either real progress on inflation, and I know we get CPI this week, which Ryan wants to discuss, or some labour market weakness. Now, for me, that payrolls report does not point to any labour market weakness whatsoever. Solid jobs growth, low unemployment, earnings ticking along at a decent clip, and also all of that is pretty broad-based across the economy as well. Should keep the Fed on hold and also see the Fed remain as something of a hawkish outlier among G10 central banks, particularly as you look elsewhere. That in turn should be a tailwind for the dollar, but of course for equities, it sees that Fed put, that comfort blanket that participants had for the bulk of 2023 and 2024 is still not there. So while the path of least resistance should lead higher, I think that path is going to be a pretty bumpy one, as we've seen over the last couple of weeks. Well, it's a shame with all those bribes you took for the sweepstake, you couldn't get a microphone that works, Ryan. What's going on?
Oh, look, rules. My microphone's working fine, thank you very much. Yeah, solid report, very, very solid. Has been for a long while. We've been talking about wages. They've stayed steady around that 4% mark for, pretty much a couple of years now. So there's nothing in the numbers that got the market wobbling at all, although it did have a first wobble on that initial number. But I think you're right, looking at stocks and looking at the S&P, there is no reason why there should be a Fed put, because stock markets keep going up. We haven't come too far from those 6,100 highs. The dips keep getting bought up. We're not dipping too far. And you've got to think, if the economy is going to keep performing the way it has, then we're going to be heading much higher in stocks sooner rather than later. Yes, you can look at the tech stock side of things and the wobbles that are coming from that side of things. But as far as the economy is going and concerned, it's solid numbers all the way. Whether the Fed is going to get more hawkish, though, that's another question, because the market's already starting to edge that way, but it's going to need something more for it to get really hawkish. I think we're down to one cut at the moment after the non-farm payrolls, and June/July is still the number, as was set up by the Fed or by the market after the Fed and FOMC. So, yeah, you can't bet against the US economy at the moment.
No, you really can't. And I think actually the Fed would say that policy is in a good place. We've had 100 basis points worth of cuts. We are still probably 100-ish basis points above neutral. So they've got some flexibility. And I think market pricing is probably in a good place as well. 40 odd basis points of cuts discounted by the OIS curve by year end, which seems about right. The Fed have said in the dots that they want to deliver 50. Market's naturally going to price a chunk of upside inflation risk on the whole tariff tit for tat that seems to keep going on and get worse every week. So, yeah, everything just seems to be kind of ticking along okay at the moment. But in any case, we had a look at one side of the dual mandate in terms of the labour market last week. This week even, we get the other side of the dual mandate.
Yes, and it says they're more fodder for the Fed trade as well, because we get the first 2025 inflation numbers on Wednesday as the US CPI data comes to town. Now, the headline's expected to stay sticky at 2.9%, with the core following up on the December number, coming down another pip to 3.1% from 3.2%. Now, as I said, since the FOMC, the jobs data as well, the market has penned June in as the next time the Fed may potentially cut, and only cut once more this year. So we've got a lot of room here, I think, for the expectation trade to shift around, particularly on a soft number. But it also has to be a really soft number in the CPI, like 2 or 3 pips or more lower in those numbers. I believe right now, I think we're going to see more aggressive pricing on softer numbers and softer data overall than on unchanged or perhaps a higher number, as the market will change around, bring forward those Fed cut expectations rather than pushing them out further, because they are pushed out quite far already. Now, for what happens with the dollar, we have to look no further than what happens in US 10-year yields. Last week, we had a pretty solid break below 4.5%. Fell very hard down to 440, which we then tested again over the NFP data initially, before bouncing back strongly to 4.5% again. Now, where yields sit after the CPI data will be our guide for what happens in the dollar and dollar pairs, obviously. But remember, the Trump trade still remains and means that not all US dollar pairs are equal. So watch out for those threats and tariffs and headlines and whatnot, because that could still shift around some of these dollar pairs. 10-year yield, as I see, we've got it on the chart here, we're up and around, back up around that 4.5% mark. So I think this is really a big pivot point for the dollar moving forward.
Yeah, I think you're right. I mean, just to take it back to CPI for a second before we discuss markets a little bit more. I actually don't think there's any point in paying much attention to this week's CPI number. And to be honest, I'd say the same about PPI on Thursday. And the reason for that is that both of them reflect the economy, how it was before Trump came into office, and also before all of these tariffs were imposed. And I think the bulk of January's data releases, certainly those which are impacted by external factors, are really going to be taken with a pinch of salt by market participants, because even more so than normal, I mean, it's only been 3 weeks since the end of the month, but the economy has moved on so significantly in that period that actually the data is already pretty stale. Now, I think you're right in saying if we do get a big outlier print, then that could shake things up a little bit. But fundamentally, I think the CPI number is really going to speak to just strengthening the narrative that's already embedded, which is that headline inflation is still being distorted by one-off factors like energy prices. And also, I think there's a pretty unfavorable base effect coming in, and that the pace of underlying disinflation is probably a bit too slow for policymakers' liking, but nonetheless, those price pressures are still fading in a relatively sluggish manner. I think you're absolutely right in saying that the dollar's going to take its lead from where treasuries head. All else being equal, I'd sit here and go 4.5% on the 10-year is a screaming buy, given you want to lock in that yield. But when you've got a president who is just throwing the word tariff around left, right, and centre, and even himself doesn't know what's going to happen next, I think there's a dose of caution needed. And the other thing that I would say, and just lastly on this, while we're talking about treasuries, is on Sunday, Trump made what I would say is probably the most important and also the most worrying remark of his presidency so far, and that is that when he's been talking about how the Department of Government Efficiency have apparently found some evidence of irregularities with treasuries, and that may mean the US's debt obligations are lower than previously thought. Now, put yourself in the mind of a US bondholder. Are you going to want to be in a position where one day you get a call from a friendly man at the Treasury Department saying, oh, that bond you're holding, we're not going to pay the interest on it anymore, and we're not going to pay your principal back. It's null and void now. My best hope here is Trump was just being incredibly stupid and incredibly ignorant. And to be fair, the White House did pull a very, very quick U-turn on this one. But if that wasn't the case, and this is the start of the US potentially weaponizing its debt obligations, nobody is going to want to hold treasuries whatsoever.
Well, I don't know where you want to go with this one, Mike. You might as well do a whole show of that compared to the news that are coming out. They've spoken that it might be down to gold, and they're going to revalue gold in their national accounts, and that will help get rid of debt. I've lost track of it. It was a dangerous comment to make off the fly like he does. We don't know the details and how it's all going to turn out. I've heard people saying that part of that is to do with all the property that the US government owns, and they could flog that off and help pay off the debt and whatever. It's a big question. It needs proper answering, and if Trump does it the way Trump does it, then expect some waves to come from that.
Well, yes, that is very true. So the US economic and political landscape, it's ever changing. Some things in this world never change, and one of those is that the Bank of England are still as shambolic as ever. They're in a bit of a mess, to be honest with you, stuck between a rock and a hard place, and to be honest, they're both of their own making, the way things have gone over the last few years. Now, first things first, the BOE did indeed deliver a 25 basis point cut last week, the third of the cycle, lowering bank rate to 4.5%. That said, the cut in question was voted through by a 9-0 vote among members of the Monetary Policy Committee. That's your first surprise. The second surprise was that two of those members of the Monetary Policy Committee decided that they would instead prefer a 50 basis point cut. The third surprise, one of those policymakers calling for a 50 basis point cut, was Catherine Mann. Now, for those of you who don't follow the BOE particularly closely, Catherine Mann, she's an external member of the Monetary Policy Committee, and over the last couple of years, she has staked her claim to be the uber hawk among policymakers down the road on Threadneedle Street. As soon as November, she was saying that 100 basis points worth of easing this year would be too aggressive, and that there are still intense signs of inflation persistence within the UK economy. That was the last time we heard from her, and since then, I think she's been drinking something very, very strong to suddenly pivot from no rate cuts whatsoever to, hang on a second, let's get on with this and slash rates with a jumbo cut. Now, Catherine Mann does speak on Tuesday morning, so it'll be interesting to see how she explains herself. But I think the issue for the BOE is that all of that dovishness in terms of the vote split came amid a pretty grim set of economic forecasts. In short, the bank revised their GDP growth expectations lower, actually cutting in half their forecast for economic growth in 2025. And at the same time, they revised their inflation forecasts higher, with CPI now expected to peak at 3.8% in the third quarter of this year, up from 2.7% in the November forecasts. And just for those of you who aren't aware, they're meant to be getting inflation to 2%, not up to 4%. So that does somewhat explain why the BOE kept their guidance, saying that they will continue with a gradual and careful approach. The word careful is new, but I'm not sure it means particularly much, and stressing that they're going to continue with this data-dependent stance. But to be honest with you, I think policymakers have forgotten that the job they're given is to get inflation back to 2%. And they don't expect inflation to get back to 2% for another 3 years, as near as makes no difference. The Bank of England's job is not to try and prop up economic growth by cutting rates in an attempt to bail out the government for their inept management of the economy. Now, fundamentally, the Monetary Policy Committee's forecasts point to what we've been saying for quite some time on this show, stagflation here in the UK. And of course, Governor Bailey delivered another classic press conference after the decision, where he said that the upswing in inflation will be temporary, which is what he said in 2021, and we still haven't got back to the target sustainably since. And he also said he doesn't like to use the word stagflation. Well, Mr. Bailey, you're going to have to get used to that one, mate, because it's what's happening here in the UK. And personally, I don't see anything to like about the economy or anything to like about the pound at this moment in time.
Are you glad now you got that off your chest? You look a bit relieved now after that read.
I feel better. I do feel better.
Good. It's good. It's good to speak out and release your feelings. I mean, unfortunately, I was off sick for the actual decision. But when I called up with it and I saw a 9-0 vote and then 2 votes for 50, and one of those being it was a complete head scratcher. But yeah, that was countered quite significantly because we saw a sell-off in the quid. That was countered quite significantly by the statement afterwards saying that they need to be careful. Inflation is still a problem. I'm the same as you. They keep saying that inflation, they expect it to tick up into Q3 or something, but it's not going to bring second round effects, i.e. affect core inflation. I think that's a load of hogwash. If you're going to have 6-7 months of higher CPI, it's going to feed into the core number naturally. So I think that's a load of rubbish from them. But yeah, we use analogy every time we talk about the Bank of England, rock and a hard place. That's where they're stuck. They're always stuck there. They might as well just build the Bank of England between said rock and hard place and be done with it. As far as the pound goes, and I know you like to look at cable now and again, so I've got the cable chart here. The thing that we notice, particularly price-wise action, is that we've stopped going down. We haven't managed to make new trend lows in that move from the 134s. So that's your first bit of evidence from this side that perhaps the pound has stopped going down, particularly versus the dollar. Now, obviously, a lot of that is probably down to the dollar side of things. So I think you've got to be careful. Would you buy the pound on what's going on in the UK, the fundamentals? Probably not. But if you're matching it off against the dollar, and if the dollar has reached a bit of a peak here, then there's certainly room for some further upside in cable, maybe up over that 126 area up to 127. But it's on a knife edge for me. We're still in this downtrend. We're not really breaking it. And possibly I think we see a bit of sideways action here before we do see a significant move, be it further dollar strength and downside or we're breaking back up.
Well, time will tell on that front. Before we move on, question for you. Andrew Bailey, his term as BOE governor expires 15th of March 2028. So effectively 3 years, 1 month from today. Before he leaves the bank, do we get a quarter of inflation at 2%?
No.
I would agree with you on that one. Unless we go into a very deep recession, I would be very, very surprised. In which case, his obituary as Bank of England governor could be quite a spicy one to write at some stage. In any case, moving on, probably the only place that wants to see high inflation at the moment, the land of the rising sun.
Yeah, absolutely. This is getting dangerous, mate. We keep agreeing with each other on these sort of questions now.
I don't like that.
Yeah, no, sends a shiver down my spine. Anyway, over in Japan, it doesn't matter what data you look at these days, it's all coming up roses for the Bank of Japan and the government as well. We had super strong earnings last week, which included real wages turning positive once again. That was also highlighted in the services PMI. There was a gain there. Also, price pressures, the highest or moving at the fastest since last August. We've seen stronger spending data, retail sales data, and all that is coming on top of inflation, which is still sailing merrily above 2%. Now, there may be some year-end skews in those wages numbers, things like bonuses coming through at the end of the year, but we're not going to find that out until next month. But for now, the Bank of Japan will have an eye on those upcoming spring wage negotiations. And the market, though, isn't expecting another hike until maybe into the summer. But the way this data is going, we might be in for a faster hike than expected. Now, all that and the good Trump-Ishiba meeting on Friday has caused some divergence for the yen and especially dollar yen, which usually shadows US yields. We dropped the best part of 500 pips last week and remained near the lows, even as we saw that bounce in US 10s on Friday. We broke back under the 152 level and look on course to test 150 or lower. However, today we've had another bounce back up and we're back above 152. But for me, if we do continue this move lower, the big level down here is down at 149.20, 30. So I'd be very careful trying to catch the knife before that level, I think. But what do you make of this, Michael? It's all going the right way for Japan.
Yeah, it does seem to be. And actually, you know what, there is a lot to like about Japan at this moment in time. And I think one thing that the market is really starting to buy into is this budding friendship, I suppose, between President Trump and PM Ishiba, who seem to be getting on like a bit of a house on fire at the moment. And I think by extension, participants are kind of betting that, if that is indeed the case, maybe Japan is going to be spared the worst of some of these tariffs that may start to be thrown around, even if Trump has just kiboshed the Nippon Steel US Steel merger. But very much a sort of give with one hand and take with the other. But it does seem that the BOJ are going to be able to continue this hawkish stance. I think the market is probably pricing that next hike a little bit too far away. And of course, one thing that we know the BOJ are concerned about is market volatility. And yes, things are choppy, but one, the yen's moving in the right direction for them. And two, you wouldn't exactly say things are disorderly at this moment in time. And secondly, the fact that the Fed are likely to be on hold for, well, it's not a skip now, it's probably a pause for the bulk of the first half of the year. That just keeps the door open for the BOJ to be able to continue with that hawkish rhetoric and maybe squeeze in another hike or two during that period, which in turn, when you think about something like carry trades, is potentially another threat for those positions, which were already struggling as a result of elevated volatility and are now likely to be further struggling as a result of the narrowing rate differential.
Yeah, very much so. Even though I think it's still going to be a very slow and steady pace from the Bank of Japan, but it is going to narrow, and it's going to have the carry traders questioning, can they get better yield elsewhere, better returns elsewhere. In terms of dollar yen, yeah, I think at the moment it's a rally selling market. We had a big breakdown at the 153.70, 80 level, so any return up there, I think, is going to find a ton of sellers coming in. And the trend for the year is down, so you can't fight that for the moment.
No, absolutely not. Right. Well, on that note, let's move on to our plays of the day. So, having spoken earlier about the perils of trading the broad dollar, guess what I'm going to do? Talk about the broad dollar. Nevertheless, the dollar index, as we said, trade has been somewhat choppy, but as you can see on the chart there, since really the middle of December, just before Christmas, we've broadly been in a kind of range between about 107.5, 107 to 110 at the upside. And it just does seem to be a bit of a yo-yo at the moment, where we'll get some protectionist rhetoric and that will see us race towards the top side of that range. And then we'll get some conciliatory comments on trade, or we'll see Trump unwind the tariffs that he's put in place, as he has done the last couple of weeks in a row. And then we'll come back down towards the bottom of that range. And we're just kind of bouncing around, ultimately not going anywhere particularly quickly. Now, I think taking a bit of a broader view, the elevated and continued level of policy uncertainty does make it difficult for participants to sit in short dollar positions in any particular size or for any particular length of time. And I think as a result of that, you'd expect that support towards the downside at 107, 107.5 should hold. Personally, as we explained earlier, I continue to like the dollar higher. I think the Fed are going to remain hawkish compared to their G10 peers. I think also we're going to see continued outperformance of the US economy. And even with tariffs being ultimately a zero-sum game, you would still expect the US economy to prove more resilient than its peers. So personally, I would be buying the dip in the dollar here, but it's certainly not one that I would be getting overly greedy with. I think the range has been very, very well defined at this moment in time, and we just play that for now.
Yeah, absolutely. And a range play is what I'm looking at pretty much here with my play of the day as well. Last week's S&P break attempt strategy didn't come to fruition, and while I'm still looking to play that up at that 6,100 level, I've got my peepers set on dollar CAD now too. Now, the good thing about break trading is that you risk nothing until the level breaks, until your level breaks, thus then triggering your trade. Some people often ask me, if I think a price is going to break a level, why don't I trade in front of it, trade ahead of the level and try and catch the move? The reason I don't often do that is because I'd be risking money on a possibility rather than when the level breaks, which then makes a trade a sort of actuality. Now, in terms of dollar CAD, we've made a real fist of support down here into the 143, particularly 142, 60, 70. And I'm now eyeing a break trade there. Now, I might even be keen still on trying a long off that level if it holds once again. But otherwise, if the level breaks, I think given the strength we've seen in that support holding, a solid break is likely to have some legs. I wouldn't be surprised if it was trading down to 142 even or even more than that, and very quickly. So I'm looking for a break trade if it goes under that 142, 60, 70 area, and see where we end up.
Indeed, we'll see what happens with that one. I think, personally speaking, I think the market might have got perhaps a little bit complacent with the Canadian dollar. Tariffs being postponed for 30 days is not the same as tariffs never happening whatsoever, but time will tell on that front. I'm not even sure Trump knows what he's going to do next with that one, let alone trying to second guess it. In any case, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining us. Thank you, as always, as well, to our producer, Kyriakos, for bringing things together as brilliantly as always. Hopefully, you've enjoyed the show. If you have, do drop a like on the video, leave a comment as well. Let us know how you're trading the markets, and all three of us will be back with another episode of The Trade-Off this time next week. In the meantime, thanks again for watching. Goodbye for now.